Right now, over 40 million Americans are carrying credit card balances they can't pay off. Every month, the statements come. The minimums rise. The interest grows. And one day, it happens. You just don't have enough to make the payment. Maybe you tell yourself it's temporary. You'll catch up next month. But deep down, there's that sinking feeling that this is the start of something worse. Have you ever been there? That moment when your phone rings and you already know it's the bank calling? Tell me in the comments, what did you do the first time you couldn't make a payment? Your story might help someone else watching right now. Here's what most people don't realize. When you stop paying a credit card, there's a chain reaction, a predictable series of events that can last for months, even years. Every step has consequences. But if you understand what's happening and why, you can make smart moves to minimize the damage and recover faster. In the next 40 minutes, I'll walk you through the full timeline. What happens after one missed payment, after 3 months, after 6 months, and what to do if you've already been sent to collections or sued. I'll show you the legal protections you have, the mistakes that make things worse, and the strategies that actually work. Let's start at day 1. Step 1. The first missed payment, days 1 to 30. The moment you miss your due date, the system flags your account as past due. You'll get a late fee, usually around $25 to $40, added to your balance. If it's your first time missing a payment in over 6 months, some banks may waive it if you call and ask. This is called a courtesy adjustment, but the clock has already started ticking. By law, credit card companies typically don't report you as late to the credit bureaus until you're at least 30 days past due, though internal systems might flag it sooner. So if you're just a few days late, you still have time. Pay before day 30, and it might never hit your credit report. This is your window. But here's the catch. Interest compounds daily. Every single day you don't pay, the balance grows. And if you miss a payment and carry a balance, you lose your grace period, meaning new purchases start accruing interest immediately. If you've been paying your balance in full every month, you had a grace period where purchases didn't accrue interest until after the due date. The moment you carry a balance past the due date, that grace period disappears. Now you're paying interest on everything, even new purchases you make today. That interest starts accumulating from the transaction date, not from the statement date. Let me give you a real example. Say you have a $5,000 balance at 22% APR. That's about $3 per day in interest. Miss your payment for 30 days, and you've added $90 in interest alone, plus a $35 late fee. Your $5,000 debt is now $5,125. And that's just 1 month. This compounds every single day you're behind. If you miss that first full cycle and hit 30 days late, you'll start getting phone calls and emails. They'll sound friendly at first. We noticed you missed your payment. Can we help you get back on track? What they're really doing is testing your situation, trying to see if this is a temporary hiccup or the start of a default. They're gathering information. Can you pay? When can you pay? What's your situation? Are you unemployed? Did you have a medical emergency? They're building a profile. If you can pay even the minimum, do it. Because once you hit 30 days late, things get real. But if you absolutely cannot make the payment, don't hide. This is the time to call them first. Explain your situation honestly. Say, I lost my job, or I had a medical emergency, or whatever the truth is. Sometimes, the bank can set up a hardship program, temporarily lower your interest rate, skip a payment, defer the balance, or close the card but freeze interest for a few months while you get back on your feet. These programs exist, but you have to ask for them. They won't offer them unless you call. Most people are too ashamed to make that call. They avoid it. They let the 30 days pass. That's a mistake. The earlier you communicate, the more options you have. Banks would rather work with you than watch you default completely. They've already invested in acquiring you as a customer. They'd prefer to keep you paying something rather than lose you entirely. But they need to hear from you. Silence makes them assume the worst. Here's what you should say when you call. I'm experiencing financial hardship due to specific reason. I want to stay current on my account, but I need temporary assistance. What hardship programs do you offer? Don't apologize excessively. Don't over-explain. Just be direct. Many banks have formal hardship programs with names like payment assistance or financial relief. They might reduce your interest rate temporarily to 0 to 6%, lower your minimum payment, or let you skip a payment while freezing interest. Get any agreement in writing before you rely on it. Step 2. 30 to 60 days late. The credit damage begins. Now your account is officially delinquent. That means the bank has reported it to the credit bureaus, Equifax, Experian, and TransUnion. All three now show a 30-day late payment on your credit report. Your credit score could drop anywhere from 60 to 120 points depending on your credit history. If you had perfect payment history before this, the drop will be severe. If you already had some blemishes, the impact might be less dramatic. But either way, that one missed payment is a huge red flag to the credit scoring algorithms. It says, this person is struggling to manage their obligations. The credit scoring models, FICO and VantageScore, weigh payment history as the single most important factor, typically accounting for about 35% of your score. A 30-day late payment is a serious derogatory mark, and it stays on your report for 7 years from the date it was first reported, though its impact diminishes over time. In the first year or two, it hits hard. After 3 to 4 years, if you've rebuilt good payment history on other accounts, its weight decreases. You'll keep getting calls, emails, texts, and letters that say things like, urgent, your account is seriously past due, or final notice. These letters are designed to create urgency and stress. Some of them work. Some banks will now block new charges on your card. You might try to buy groceries or gas. Declined. That's how most people realize they've officially crossed the line. Your card is effectively frozen until you catch up. The interest keeps piling up. Late fees keep getting added. If you miss another payment and hit 60 days late, that's another separate derogatory mark on your credit report. Your score drops again. At this point, you're looking at significant damage. If you had a 720 credit score before, you might be down to 620 or 600 now. That affects everything. Your car insurance rates might go up because insurers check credit in most states. If you're trying to rent an apartment, landlords will see this. If you're applying for a job in finance or any position that requires a credit check, they might see it too. Your entire financial life starts to feel the ripple effects. Here's something else that happens around this time. If you have multiple credit cards, the others might also cut your limits. Why? Because banks share data through the credit bureaus. When one bank sees your delinquency, others panic. They assume you're a risk across the board, so they proactively lower your available credit on their cards, even if you've never missed a payment with them. This raises your credit utilization ratio on your other cards. If you were using $2,000 of a $10,000 limit, that's 20% utilization. But if they cut your limit to $5,000, suddenly, you're at 40% utilization. High utilization tanks your score even more. It's a domino effect. One missed payment can cascade across your entire financial life. If you still can't pay, keep communicating. Answer the calls when you can. Be honest. Some banks will offer a payment plan at this stage. They might say, we'll split your past due amount over the next 6 months if you agree to make regular payments going forward, plus a portion of the arrears each month. It's not ideal. You're still accumulating interest, but it keeps you from spiraling further into default. And it shows good faith, which matters if things escalate to collections or legal action later. Courts and collectors look more favorably on people who tried to work things out rather than people who disappeared. Step 3. 60 to 90 days late, penalty rates and escalation. At this point, the tone changes dramatically. No more friendly emails asking if you need help. Now it's formal letters, notice of default, right to cure, last warning before charge-off. The language is aggressive. The banks are preparing to either escalate internally or sell your debt to a third-party collector. Your late fees continue to pile up. After 60 days late, many issuers impose a penalty APR, often as high as 29.99%. This isn't automatic for everyone. It depends on your cardholder agreement. But most major issuers have penalty rate provisions that kick in after 60 days of delinquency. Think about that, nearly 30% interest. If you owed $5,000, you're now adding over $120 in interest every single month, even before late fees. Your debt is growing faster than you can keep up with, even if you wanted to pay. This is by design. The penalty rate is meant to punish you and also to maximize the bank's recovery if you do start paying again. Every dollar you send them now is mostly interest. Your credit score is likely down another 20 to 40 points by the time you hit 90 days late. You're now 60 days late, then 90 days late. Each milestone gets reported as a separate derogatory mark. The credit bureaus distinguish between 30, 60, 90, and 120 plus days late. Each one is progressively worse. If you have multiple credit cards, the others might cut your limits even more aggressively now. Some might close your accounts entirely, even if you're current with them, because they see you as a systemic risk. At 90 days, your account is seriously delinquent. The bank assumes you're not going to pay. Internal collections departments take over if they haven't already. You'll start getting several calls a day, some automated, some from live agents. They'll ask for the full balance, or offer settlements, or promise to help you avoid charge-off if you pay something substantial now. They might say things like, if you can pay $2,000 today, we can keep your account from going to charge-off. This is a negotiation tactic. They're trying to recover as much as possible before they give up. This is the moment most people stop answering the phone. They feel embarrassed, angry, hopeless. They see the number, they know who it is, and they hit decline. That's understandable. The shame is overwhelming. But avoiding the calls makes things worse because now the bank has no information about your situation or your intent. Silence is interpreted as abandonment. If you can't pay, at least answer once and explain your situation clearly. Say, I'm unemployed and I have no income. I cannot pay right now, but I will resume payments when I'm employed again. That creates a record of communication. It might not stop them from charging off the account, but it establishes that you're not trying to commit fraud or skip out entirely. Step 4. The charge-off, 120 to 180 days. What it really means. Once your account hits 180 days late, 6 full months, the bank will typically charge it off. Let me be very clear about what this means, because there's massive confusion around this term. Charge-off does not mean the debt disappears. It does not mean you don't owe it anymore. It does not mean they've forgiven it. Charge-off is an accounting term. It means the bank is writing off the debt as a loss on their books for tax and financial reporting purposes. They're telling the IRS and their shareholders, we gave up on collecting this. We're taking a loss. But legally, you still owe the money. The debt is still valid. And they can still try to collect it, or they can sell it to someone else who will try to collect it. The charge-off shows up on your credit report as one of the worst marks you can have. It's categorized as a major derogatory and stays there for 7 years from the date of first delinquency, meaning 7 years from the date you first missed the payment that led to the charge-off. Not 7 years from the charge-off date itself. Your credit score has now tanked. If you started at 720, you might be in the low 500s or even high 400s now, depending on what else is on your report. Getting approved for anything, a car loan, an apartment, even a cell phone contract, becomes extremely difficult. Many landlords have a hard floor of 600 for credit scores. You're below that now. At this stage, The bank has two options. They can keep the debt in-house and continue trying to collect it themselves through their own recovery department, or they can sell it to a third-party debt buyer. Most of the time, they sell it. Why? Because they've already written it off as a loss. If they can sell it for even a few cents on the dollar, that's better than nothing. It's found money. So your debt gets bundled with thousands of other charged-off accounts and sold in a portfolio to a debt collection agency or a debt-buying company. The prices vary, but typically debt buyers pay between 3 and 8 cents on the dollar, depending on the age of the debt, the size of the balance, and whether there's any documentation. If you owed $10,000, they might have paid $300 to $800 for it. Some older debts with missing paperwork sell for as little as a penny on the dollar. That's why debt collectors are so aggressive. Every payment you make is almost pure profit for them. They have very little invested. When that sale happens, your phone starts ringing from new numbers. You get letters from companies you've never heard of: Portfolio Recovery Associates, Midland Credit Management, LVNV Funding, Cavalry Portfolio Services. These are debt buyers. They're private companies that purchase and collect charged-off debt. The letters often look official, almost governmental. They're not. They're private businesses trying to scare you into paying. Step 5. Dealing with debt collectors. Know your rights. Now you're in the collections phase. This is where things can get ugly if you don't know your rights. Third-party debt collectors, not the original creditor, operate under the Fair Debt Collection Practices Act, a federal law that strictly limits what they can and cannot do. The FDCPA applies to third-party debt collectors, not the original creditor, though most banks follow similar standards to avoid state law violations and reputational damage. Here's what debt collectors cannot do. They cannot call you before 8 a.m. or after 9 p.m. in your time zone. They cannot call you at work if you've told them your employer doesn't allow personal calls. They cannot harass you with repeated calls intended to annoy or abuse. The law doesn't specify an exact number, but courts have found that calling multiple times per day, every day, can constitute harassment. They cannot threaten you with violence, arrest, or criminal prosecution. Debt is a civil matter, not criminal. They cannot lie about the amount you owe or falsely claim to be attorneys, government officials, or credit bureau representatives. And critically, they cannot disclose your debt to third parties beyond what's necessary to locate you. They can't call your family, your friends, your neighbors, or your co-workers and tell them you owe money. They can contact third parties to try to locate you, but they can only identify themselves and ask for your contact information. They cannot mention the debt. But violations happen constantly. Collectors push boundaries because most people don't know their rights. They call at 7 a.m. or 10 p.m. They call your workplace after you've told them not to. They threaten arrest. They imply you'll lose your house over a credit card debt. They leave voicemails that reveal the debt to other household members. They contact your relatives and tell them you're a deadbeat. All of this is illegal. If a collector violates the FDCPA, you can sue them in federal or state court. You can recover up to $1,000 in statutory damages per violation, plus any actual damages you can prove, plus your attorney fees. Plenty of consumers have won these cases. There are attorneys who specialize in suing debt collectors for FDCPA violations, and many work on contingency. Here's what you should do if you're contacted by a debt collector. First, do not ignore them. Ignoring doesn't make it go away. It just limits your options. Second, within 30 days of their first contact, send a written request for debt validation. This is your right under the FDCPA. The letter should say, "I am requesting validation of this debt as allowed under the Fair Debt Collection Practices Act. Please provide documentation showing that I owe this debt, including the name of the original creditor, the original amount owed, an account statement, and proof that your company has the legal right to collect this debt." Send it certified mail, Return receipt requested so you have proof they received it. Once you send that letter, the collector must pause all collection efforts until they mail you verification. They don't have a specific deadline to respond, but they cannot continue trying to collect until they've sent you documentation. If they can't validate it, and sometimes they can't, because the paperwork gets lost when debts are sold multiple times, they have to stop trying to collect and remove it from your credit report. Even if they can validate it, this process buys you time and forces them to prove they actually own the debt and that the amount is correct. If they do validate it and you genuinely owe it, you can negotiate. Debt collectors are often willing to settle for 40 to 60% of the balance if you can pay a lump sum. Some will go as low as 30% on very old debts. Why? Because they bought the debt for pennies. Even at a steep discount, they're making money. If you owed $10,000 and they bought it for $300, they'll gladly take $4,000 or even $3,000 from you. That's still a massive profit margin for them. But, and this is absolutely critical, get the settlement agreement in writing before you send any money. Do not trust verbal promises. The agreement must state the exact amount you're paying, that this payment settles the debt in full, and that they will not sell any remaining balance to another collector. It should also specify that they will update your credit report to show the account as settled or paid for less than the full balance. Without this in writing, you could pay them $4,000 and then have another collector come after you 6 months later for the remaining $6,000. It happens all the time. Protect yourself with written agreements. One more thing. If you're negotiating a settlement, do not give them electronic access to your bank account. Do not authorize an automatic withdrawal. Do not give them your debit card number. Pay with a cashier's check or money order after you have the written settlement agreement. If you give them access to your account, some will take more than agreed, or they'll keep withdrawing even after the settlement is paid. I've seen it happen countless times. If you've ever reached this stage, 90 days, 120 days behind, dealing with collectors, how did they treat you? Were they respectful, or did they cross the line? Tell me in the comments. I want to see how people are being treated out there. Your experience could help someone else recognize when their rights are being violated. Step 6. The lawsuit stage, when collectors take you to court. If you ignore collection attempts long enough, some creditors will sue. Not all will. It depends on the size of the debt, the state you live in, the age of the debt, whether they have solid documentation, and whether the collector thinks they can win and actually collect. Lawsuits cost money: filing fees, attorney fees, court costs. If you're judgment-proof, meaning you have no income or assets they can take, they might not bother suing. But if you have a job, a bank account, or property, they're more likely to file. If they do sue, you'll receive a summons and complaint. This is a legal document notifying you that you're being sued for the debt. It will tell you the amount they claim you owe, the name of the plaintiff, usually the debt buyer or collection agency, and the deadline to respond. That deadline is typically 20 to 30 days depending on your state. Some states give you as little as 14 days. The clock starts the day you're served, not the day the lawsuit was filed. Most people panic when they get served. They throw the papers away. They pretend it didn't happen. They think if they ignore it, it'll go away. That's the worst thing you can do. If you ignore a lawsuit, the collector automatically wins something called a default judgment. This is a court order saying you owe the money because you didn't show up to defend yourself. With that default judgment in hand, they can garnish your wages, levy your bank account, or place a lien on your property in some states. Wage garnishment means they can take money directly from your paycheck. Federal law generally caps wage garnishment at the lesser of 25% of your disposable earnings, or the amount by which your weekly disposable earnings exceed 30 times the federal minimum wage. Some states provide stronger protections and allow less than 25%. A few states, like Texas, North Carolina, Pennsylvania, and South Carolina, don't allow wage garnishment for consumer debts at all except for child support, taxes, and student loans. but in most states, they can take up to 25% of your take-home pay. If you're making $2,000 every 2 weeks after taxes, they can take $500 per paycheck. That's devastating if you're already struggling. A bank levy means they can freeze your bank account and take whatever money is in there to satisfy the judgment. One day, you try to use your debit card and it's declined. You check your account online and see it's frozen. All your money is gone. They can take it all up to the amount of the judgment. Some states have exemptions that protect a portion of your bank balance if it's from Social Security, disability, or other protected sources, but you usually have to go to court to claim those exemptions. Most people don't know to do that, so the money just gets taken. But here's the key. If you respond to the lawsuit, you can fight back. Debt collectors often lack the documentation to prove they own the debt or that the amount is correct. When debts are sold multiple times, the original contracts, account statements, and payment histories sometimes don't transfer properly. The debt buyer might have a spreadsheet with your name and a balance, but they don't have the signed credit card agreement, the terms and conditions you agreed to, or the detailed transaction history showing how the balance accrued. If you file an answer, a written response to the lawsuit, and demand that they prove their case, many lawsuits get dismissed or settled for much less because the collector can't produce the required evidence. You can raise defenses like, prove you own this debt, show me the assignment documents from the original creditor to you, or the statute of limitations has expired on this debt, or the amount you're claiming is incorrect. Provide an itemized accounting. If you're sued, do not ignore it. Respond in writing, on time, within the deadline stated in the summons. If you can't afford a lawyer, look for legal aid organizations in your state. Many states have legal aid societies that help low-income people defend against debt collection lawsuits for free or low cost. You can also consult with a consumer rights attorney. Many attorneys who handle debt defense work on flat fees or payment plans. This is worth the investment if you're facing garnishment or a levy. Even if you respond and eventually lose, having fought the case gives you leverage to negotiate a better settlement before the judgment is entered. Collectors would often rather settle for 50 to 70% than go through a full trial. So responding buys you time and options. Step 7. Statute of limitations. Time-barred debt. Here's something crucial that a lot of people don't know. Every state has a statute of limitations on debt. This is the time period during which a creditor can legally sue you to collect. It ranges from 3 years in some states to 10 years in others, but most states fall between 4 and 6 years. The clock usually starts from the date of your last payment or the date of your last account activity, depending on the state. After the statute of limitations expires, the debt becomes time-barred. That means the creditor or collector can still ask you to pay. They can still call. They can still send letters, but they cannot sue you. If they try to sue you on a time-barred debt, you can go to court, raise the statute of limitations as an affirmative defense, and have the case dismissed. The judge will throw it out. But here's the trap. In some states, making a small payment or acknowledging the debt can reset the statute of limitations, restarting the clock. Let's say your debt is 5 years old and your state has a 4-year statute of limitations. The debt is time-barred. But then a collector calls and you say, yes, I owe it. I just can't pay right now. Or you send them $50. In many states, that resets the statute of limitations. Suddenly, the clock starts over at 0, and they have another 4 years to sue you. This is why you have to be extremely careful when dealing with old debt. Before you agree to pay anything on an old debt, check your state's statute of limitations. Look up when your last payment was made. If the statute has expired, you might be better off not engaging at all. If a collector sues you on time-barred debt, your defense is simple. File an answer that says, the statute of limitations has expired. This debt is time-barred. The court has no jurisdiction to enter a judgment. You'll probably need to provide evidence of when the debt became delinquent, but if you're right, the case gets dismissed. One more thing. The statute of limitations on being sued is different from how long the debt stays on your credit report. These are governed by separate laws. A debt can be too old to sue on, but still show up on your credit report. Credit reporting is governed by the Fair Credit Reporting Act, which says that most negative items can remain on your report for 7 years from the date of first delinquency. So even if the statute of limitations for lawsuits is 4 years in your state, the debt can still hurt your credit for 7 years. These are two separate timelines. Step 8. Bankruptcy as the last resort. Chapter 7 versus Chapter 13. Let's say you've been through all of this. You stopped paying. You got charged off. Collectors are calling relentlessly. Maybe you've been sued or you're facing garnishment. You don't have the money to settle. Your income barely covers rent and food. You can't see a way out. What now? This is when you need to seriously consider bankruptcy. And I know that word scares people. It feels like failure. It feels like giving up. It feels like you're admitting you couldn't handle your life. But bankruptcy is not a moral judgment. It's a legal tool created specifically for situations like this, when debt becomes so overwhelming that there's no realistic way to pay it back. Bankruptcy is designed to give you a fresh start. It's a constitutional right. Hundreds of thousands of Americans file every year. It's not rare. It's not shameful. It's a legal strategy. There are two main types of personal bankruptcy, Chapter 7 and Chapter 13. Let's break them down. Chapter 7 is called liquidation bankruptcy. Most of your unsecured debts, including credit cards, medical bills, personal loans, and collection accounts, get discharged. That means you don't owe them anymore. They're legally eliminated. The process takes about 4 to 6 months from filing to discharge. A bankruptcy trustee reviews your assets, but in most Chapter 7 cases, people keep their essential assets because exemptions protect things like your home equity up to a limit set by your state, your car, your retirement accounts, and basic household goods. Most people who file Chapter 7 don't lose anything because they don't own much beyond what's protected. Chapter 7 is best for people with low income, few assets, and overwhelming unsecured debt they can't pay. You have to pass a means test that compares your income to the median income in your state. If you're below the median, you qualify automatically. If you're above, the court looks at your disposable income after allowed expenses to see if you have enough to fund a Chapter 13 repayment plan. If you don't, you can file Chapter 7. Chapter 13 is different. It's called a reorganization bankruptcy or a wage earners plan. You don't get an immediate discharge. Instead, you enter into a court-supervised repayment plan lasting 3 to 5 years. You make monthly payments to a bankruptcy trustee who distributes the money to your creditors according to a plan approved by the court. At the end of the plan, if you've completed all payments, any remaining dischargeable debt gets wiped out. Chapter 13 is best for people with steady income who want to keep their house or car and need time to catch up on missed mortgage or car payments. It's also the only option if you make too much money to qualify for Chapter 7. Both types trigger an automatic stay the moment you file. This is one of the most powerful tools in bankruptcy. The automatic stay is a federal court order that stops all collection activity immediately. The moment your bankruptcy petition is filed, creditors must stop calling you. Lawsuits must stop. Garnishments must stop. Foreclosures must stop. Everything freezes. It's instant relief. Violating the automatic stay can result in sanctions against the creditor, so they take it seriously. Yes, bankruptcy stays on your credit report for 7 to 10 years depending on the chapter. Chapter 13 stays for 7 years, Chapter 7 for 10. Yes, it will make getting credit harder for a while, especially in the first couple of years. But if you're already deep in collections with charge-offs and judgments, your credit is already destroyed. Bankruptcy might actually help you start rebuilding sooner because all those negative accounts get resolved. Instead of having 5 charged-off accounts dragging you down indefinitely, you have one bankruptcy that's clearly marked as discharged. Lenders can see you got a fresh start. If you're at this point, If you're drowning and you can't see another way, talk to a bankruptcy attorney. Most offer free consultations. They'll review your income, your assets, your debts, and your state's exemption laws. They'll tell you honestly whether bankruptcy makes sense or if there's another strategy that might work better. Maybe you're close to the statute of limitations expiring on your debts. Maybe you're judgment-proof and don't need bankruptcy. Maybe a debt management plan through a nonprofit credit counseling agency would be better. A good attorney will explore all options with you, not just push you into filing for the fee. Don't let shame stop you from getting advice. Bankruptcy attorneys see people in your situation every single day. You are not the worst case they've seen. You're not uniquely broken. You're dealing with a systemic problem that affects millions of people. They're there to help, not to judge. Step 9. The emotional and psychological toll. Why this matters. Let's be real for a second. Credit card debt isn't just numbers on a statement. It's not just interest rates and minimum payments and collection calls. It's guilt. It's anxiety. It's shame that sits in your chest like a weight. People stop opening their mail because they're terrified of what they'll see. They avoid phone calls from unknown numbers. They lie to their partners about how bad things are because they're too ashamed to admit it. They feel like failures. They can't sleep. They wake up at 3 a.m. with their hearts racing, thinking about the debt, calculating how they're going to make it through the month. It consumes them. And the worst part? The isolation. You feel like you're the only one going through this. Like everyone else has their life together and you're the only person drowning. Like you're uniquely bad with money, uniquely irresponsible, uniquely broken. But that's not true. Over 40 million Americans are carrying credit card debt they can't fully pay off. Millions more are behind on payments. Millions have been charged off, sued, garnished. You are not alone. You are not uniquely flawed. You are dealing with a system designed to trap you. The credit card industry spends billions of dollars on behavioral psychology, studying how to get you to swipe more, how to make minimum payments feel manageable, how to keep you in debt as long as possible because that's how they make money. They know what they're doing. They've engineered this system. They've hired PhD psychologists to design rewards programs that make you feel good about spending. They've optimized every word on every statement to maximize the chances that you'll stay in debt longer. Understanding that doesn't erase your debt, but it should erase the shame. You are not a bad person because you have debt. You're a person caught in a system that profits from your struggle. Avoidance makes everything worse. I know it's hard to face. I know opening that statement or answering that call feels impossible when you're already overwhelmed. But ignoring the problem doesn't make it go away. Every day you avoid it. The interest compounds, the fees add up, your credit gets worse, and your options narrow. The sooner you face it, the sooner you can start fixing it. And fixing it doesn't mean paying everything off immediately. It means taking one small step. Opening the mail, answering the phone, writing down what you owe, calling a credit counselor, talking to an attorney. Just one step. That's how you start taking back control. And here's something nobody tells you. The relief you feel when you finally face it is enormous. That weight you've been carrying, the dread, the avoidance, the constant low-level panic, it starts to lift the moment you take action. Even if the situation is bad, knowing exactly how bad is better than living in vague terror. Even if you can't pay, having a plan is better than having no plan. Action, even small action, gives you back your sense of agency. It reminds you that you're not helpless. Step 10. Rebuilding after the storm. How to recover your credit and your life. Let's say you've been through the worst of it. You stopped paying, got charged off, maybe you settled, maybe you filed bankruptcy. Your credit is wrecked. You're sitting at 520 or 480. Now what? You start small. You rebuild. And it's absolutely possible. I've seen people go from the low 500s to the mid 700s in 3 years. It takes discipline and patience, but it's doable. Here's how. First, get a secured credit card. This is a card where you put down a cash deposit. usually $200 to $500, and that becomes your credit limit. You can't overspend because you're essentially using your own money as collateral. The card issuer reports your payment history to the credit bureaus just like a regular card. Use it once a month for something small, gas, groceries, a subscription. Then pay it off in full every single month before the due date. Never carry a balance. Never miss a payment. This does two things. It builds positive payment history, which is 35% of your credit score, and it keeps your utilization low, which is 30% of your score. After 6 months to a year of on-time payments with a secured card, your credit score will start to rise. You might go from 520 to 580, then to 620. It's gradual, but it's real progress. Some secured card issuers will even graduate you to an unsecured card after a year and give your deposit back if you've been responsible. That's a huge win. Second, check your credit reports regularly. You can pull free reports weekly from all 3 bureaus at annualcreditreport.com. Look for errors. Debts that aren't yours. Accounts showing the wrong balance. Charge-offs that should have aged off after 7 years but are still there. Late payments reported incorrectly. If you find errors, dispute them in writing with the credit bureau. They have 30 days to investigate. If they can't verify the information, they have to remove it. I've seen people gain 50 to 100 points just by cleaning up errors. Third, diversify your credit mix over time, but don't rush it. Once you have a secured card and you've been using it responsibly for 6 months, consider a credit builder loan. These are small loans, usually $500 to $1,000, designed specifically for people rebuilding credit. You borrow the money, but the lender holds it in a savings account. You make monthly payments for 12 to 24 months. Once you've paid it off, they release the money to you. You're essentially paying yourself back, but the lender reports your payments to the credit bureaus. It builds payment history and shows you can handle an installment loan, not just revolving credit. Credit unions often offer these. Fourth, be patient. Credit repair is not fast. The charge-offs, the late payments, the collections, they stay on your report for 7 years from the date of first delinquency. You can't remove them unless they're inaccurate, but their impact diminishes over time. In the first year or two, they hit hard. After 3 years, if you've been rebuilding with positive accounts, their weight decreases significantly. After 5 years, they're almost background noise. Lenders care much more about what you've done in the last 2 years than what happened 5 years ago. Within 6 months of rebuilding, you'll see some improvement, maybe 30 to 50 points. Within a year, you could be up 80 to 120 points if you're disciplined. Within 3 years, if you've had no new negative marks and you've been making on-time payments on a couple of accounts, you could be back in the 600s or even low 700s. I've seen it happen over and over. The bankruptcy or charge-offs will still be on your report, but lenders can see you've turned things around. That recent positive behavior matters more than old mistakes. Fifth, don't fall back into the same traps. This is the hardest part. You've rebuilt your credit. You're getting offers for new credit cards. It's tempting to accept them. But if you don't change the behaviors that got you into debt in the first place, you'll end up right back where you started. Before you take on any new credit, ask yourself, can I pay this off in full every month? Do I have an emergency fund so I'm not using credit for unexpected expenses? Have I addressed the spending habits or life circumstances that caused the original debt? If the answer to any of those questions is no, don't take the credit. You're not ready. And that's okay. Rebuilding credit is not about getting back to where you can borrow a lot. It's about proving you can manage credit responsibly so that when you really need it, for a car, for a house, for an actual emergency, it's available to you at reasonable rates. Step 11. What you should do right now. Your action plan. If you're currently behind on credit card payments, here's what I want you to do tonight. Not tomorrow, not next week. Tonight. Open your notebook or your notes app and write down every credit card you owe. Write down the balance, the interest rate, how many days you're behind, and whether it's been charged off or sent to collections. Not to shame yourself, not to spiral into anxiety, but to take back awareness. Because awareness is power. You cannot make a plan until you know exactly what you're dealing with. Once you see the numbers in front of you, you can make a plan. If you're less than 30 days late, call the bank today, tomorrow morning. Explain your situation honestly. Ask about hardship programs. If they offer one, get it in writing. If you're 60 or 90 days late and you've been contacted by collectors, send a debt validation letter. Don't talk to them on the phone until you've validated the debt in writing. If you've been sued, respond to the lawsuit. Don't ignore it. File an answer or consult with a consumer rights attorney immediately. If you're drowning and there's no realistic way out, talk to a bankruptcy attorney this week. Get a free consultation. Learn your options. But do something. Don't let another day pass in avoidance. Every day you wait, your options narrow. Every day you act, even in a small way, you're taking back control. Now I want to hear from you. Have you ever stopped paying a credit card and come out the other side? What worked for you? What mistakes did you make that you'd warn others about? Your comment might be the one that gives someone else hope tonight. Drop it below. I read every single one. Final thoughts. You are not your debt. Here's the truth. Debt doesn't disappear. It evolves. It moves through predictable stages, each one with its own consequences and its own opportunities to intervene. The earlier you act, the more options you have. The longer you wait, the harder it gets. But even if you're years into this, even if you've been sued, even if your credit is destroyed, even if you're facing garnishment, it's not too late. You can still recover. You can still rebuild. I've seen it happen thousands of times. The system is designed to make you feel powerless. The fees, the penalty rates, the collection calls, the lawsuits, they're all designed to overwhelm you into either paying or giving up. But you're not powerless. You have rights under federal law. You have options. You have strategies. And most importantly, you have the ability to learn, to act, and to change your trajectory. You are not your debt. You are not your credit score. You are not defined by the number on a statement or the calls from collectors or the mistakes you made when you were struggling. You are a person with value, with potential, with a future. And that future starts with one decision: to stop avoiding and start acting. If you found this video helpful, subscribe to the channel. Next week, we're covering how to negotiate with debt collectors step by step, including the exact scripts to use and the mistakes that can reset the statute of limitations. We're also going to talk about how to rebuild credit after a charge-off or bankruptcy, including the specific secured cards and credit builder loans that work best. And if you need resources right now, debt validation letter templates, sample responses to lawsuits, links to nonprofit credit counseling agencies, state-by-state statute of limitations charts, they're all linked in the description below. Everything is free. Use them. Thank you for watching. Thank you for having the courage to face this instead of avoiding it. That takes strength. Now go. Write down those debts. Make that phone call. Send that letter. Respond to that lawsuit. Talk to that attorney. Take the first step. Your future is waiting, and it's better than you think.